Welcome to Group Insurance Daily Pulse, your rapid-fire, data-driven dive into the most critical shifts in the group benefits landscape. I'm Aria, the Actuary, here to dissect the risks and regulatory implications.
And I'm Dorian, the distribution expert, bringing you the market insights, growth opportunities, and employee experience enhancements. We've got a packed 15 minutes, so let's jump straight in. Kicking us off with a stark reminder of compliance criticality, Mercer Super has seen a significant leadership change following a $10.3 million fine. CEO Claire Ross departed effective August 13th, with Court Haas stepping in as interim. This follows a federal court order on June 29, 2026, for systemic failures to report investigations into significant member services issues, including the egregious practice of charging insurance premiums after members had died.
Stark reminder is an understatement, Dorian. This isn't merely an administrative oversight. It's a profound failure of internal controls and fiduciary duty, directly impacting P&L through regulatory penalties and incurring significant reputational damage. My immediate actuarial concern is the quantification of operational risk capital required to mitigate such systemic failures. Charging deceased members' premiums, that's an almost unimaginable lapse in data integrity and reconciliation processes.
While the failures are undeniable, Aria, this also serves as a critical differentiator for carriers and brokers who do have robust compliance and ethical frameworks. It amplifies the value proposition of transparent, technologically advanced systems that prevent such errors.
Market-wide uplift often translates to increased compliance costs, Dorian. We're talking about potential mandates for real-time death registry cross-referencing, enhanced audit trails for premium collection, and more stringent reporting requirements for service issues.
Indeed, Aria. But investing in robust systems now is a proactive move to secure future market position and client trust, rather than reacting to penalties. Moving from compliance challenges to technological advancements, Aon has just announced a significant step in digitizing commercial risk submissions. On July 15, 2026, Aon revealed a new API integration powered by its Aon Broker Copilot with Swiss Re Corporate Solutions. Swiss Re is the first carrier to integrate directly, enabling end-to-end digital connectivity across the placement lifecycle for complex risk submissions.
Aon's Broker Copilot API integration with Swiss Re Corporate Solutions is interesting, Dorian, but the devil is always in the details of implementation and data security. While end-to-end digital connectivity sounds efficient, my actuarial brain immediately flags the potential for new vectors of cyber risk. An API connection, by its nature, is a data conduit. The efficiency gains are precisely the focus, Aria. This integration is designed to drastically reduce manual errors and accelerate the underwriting process. For carriers like Swiss Re, it means faster policy placements, improved client service, and a competitive edge in a complex market. Better tailored coverage and quicker policy issuance are laudable goals, Dorian, but the actuarial validation of these integrated systems is paramount.
The strategic long-term ROI in a digitized ecosystem is undeniable, Aria. It's about building future-proof infrastructure.
Shifting gears to market performance, MetLife stock just hit a new one-year high on July 14, 2026, following a strong Q1 earnings beat and an analyst upgrade. Keefe, Bruyette & Woods raised its price target from $98 to $105, maintaining an outperform rating. MetLife reported Q1 EPS of $2.42, surpassing consensus estimates of $2.27 by 15 cents. Revenue was $14.18 billion, up 2.7% year-over-year, and they announced a quarterly dividend of $0.5925 per share, implying an annual yield of approximately 2.5%.
MetLife's Q1 performance and subsequent analyst upgrade are certainly positive signals, Dorian, but we need to analyze the underlying drivers from a P&L perspective. An EPS beat of 15 cents is significant, but what components contributed most to this outperformance? Was it favorable claims experience, higher investment income driven by interest rate movements, or effective expense management within their group benefits segment?
The strong financial performance from a major player like MetLife is a clear indicator of confidence in the broader life and health insurance market, Aria.
While market confidence is beneficial, Dorian, we must remain vigilant.
Agreed, Aria, but robust financial health provides the foundation for that stability and future innovation.
Now, let's look at a strategic portfolio adjustment. On July 15, 2026, Principal Financial Group reported lowering its stake in Arch Capital Group Ltd. by 27.7% during Q1. Principal sold 1,253,941 shares, retaining 3,274,219 shares, valued at $314,296,000 at the end of the quarter.
This divestment by Principal Financial Group is a significant capital management move, Dorian, and it warrants a deeper actuarial and risk-focused analysis. A 27.7% reduction in a strategic holding like Arch Capital Group isn't a minor rebalancing. It suggests a reevaluation of Principal's investment thesis or risk appetite.
From a distribution and market perspective, Aria, this simply reflects active portfolio management by a major financial services player. Principal Financial Group is optimizing its capital structure to align with current market opportunities and long-term strategic goals.
Maximizing shareholder value often conflicts with maintaining long-term stability if the risk parameters are stretched, Dorian. The key here is the reason for the reallocation.
It's a strategic pivot, Aria, demonstrating flexibility in a complex financial ecosystem. Finally, we're seeing an interesting convergence of financial advisory and insurance services. On July 14, 2026, Creative Planning, a registered investment advisor, RIA, with about $710 billion in assets, acquired Level Insurance Group, a Lee Summit Mo-based commercial insurance brokerage. Level specializes in complex commercial insurance, surety, and risk management. This acquisition strengthens Creative Planning's commercial insurance capabilities and expands its business advisory services, which already include retirement, accounting, tax, legal, and M&A.
This acquisition by Creative Planning is a significant development, Dorian, signaling a clear trend towards integrated financial and risk management services. However, from a regulatory and P&L perspective, it introduces several complexities. RIAs operate under a different regulatory framework, SEC, than insurance brokerages, state DOI. How will Creative Planning manage the potential for regulatory arbitrage, or more critically, ensure strict compliance across both sets of regulations? There's also the potential for conflicts of interest when an entity provides both investment advice and sells insurance products. Actuaries will be scrutinizing how this integration impacts the pricing and placement of group insurance. Will Level's existing carrier relationships be maintained, or will there be pressure to favor certain carriers or products where Creative Planning might have other financial interests? The P&L impact for traditional group insurance carriers could be a shift in distribution channel dynamics, potentially leading to increased pressure on commissions or demands for more integrated data feeds from these multi-service entities. This acquisition is a prime example of the ongoing convergence of financial advisory services and insurance, Aria, and it's a powerful value proposition for employers, particularly upper-middle market businesses. Creative Planning is building a comprehensive one-stop shop for business advisory, simplifying complex benefits and risk management strategies. For group insurance carriers, this signifies a potential shift in distribution channels as RIAs increasingly seek to offer holistic solutions. It creates new opportunities for carriers to partner with these integrated advisory firms, potentially gaining access to a broader client base that values bundled services. For brokers, it means increased competition, but also potential avenues for partnership or acquisition by wealth management firms looking to expand their offerings. Streamlined approach and enhanced client experience sound appealing, Dorian, but the operational friction of integrating two distinct business models, an RIA and an insurance brokerage, is substantial. Are Creative Planning's existing technology platforms capable of seamlessly incorporating Level's commercial insurance workflows and data? What are the implications for E&O coverage, especially when combining advice across different regulated domains? From a risk management perspective, the due diligence on Level's book of business, including its claims history, client retention, and carrier relationships, must have been meticulous to avoid inheriting unforeseen liabilities.
It's a strategic move to capture a larger share of the client's wallet, Aria, and it's a trend we'll continue to see.
And that's our deep dive into today's Group Insurance Daily Pulse. From regulatory fines shaping compliance to technological leaps in risk placement and strategic shifts in capital and distribution, the market remains intensely dynamic.
Absolutely, Aria. The underlying message is clear.
adopt, innovate, and maintain unwavering client focus.
Until next time, stay informed.